You check your credit score and it's 580. Not great. But somehow your mailbox is flooded with credit card offers promising easy approval. Meanwhile, your friend with a perfect 800 score gets almost nothing. Ever wonder why banks chase customers with bad credit while ignoring the financially responsible? Today, I'll explain why banks prefer customers with bad credit, breaking it down like you're 5 years old. By the end, you'll understand how risk-based pricing works and why the customers struggling the most are often the most profitable. Here's what seems logical at first. Banks should want responsible customers who pay everything on time, never miss payments, and keep their accounts in perfect standing. Low risk, reliable, trustworthy. The kind of person who returns your lawnmower without you having to ask. But if you look at bank profit reports and investor calls, something strange emerges. The customers with excellent credit who pay their balances in full every month are called deadbeats inside the banking industry. Not in the marketing materials, but in internal meetings and strategy documents, that's the actual term, because they generate almost zero profit for the bank. They use the card, they pay it off completely, they never pay a cent in interest. The bank makes maybe $2 from the merchant transaction fee. Meanwhile, a customer with bad credit who carries a balance and pays the minimum each month generates thousands in annual profit. Interest piles up, late fees accumulate, and over-limit charges stack like dirty dishes after a rough week. Here's where the math gets wild and reveals the truth. Say you have excellent credit and qualify for a card at 15% APR. You charge $1,000 and pay it off in full at month's end. The bank makes nothing from interest, zero profit from you. Now imagine someone with a 580 credit score gets approved for the same card, but their APR is 28% because of risk-based pricing. They also charge $1,000, but they can only afford the minimum payment each month, usually around $25 or $30. At 28% interest, that $1,000 balance takes over 5 years to pay off with minimum payments. They'll end up paying nearly $1,400 in interest alone. The bank just turned a $1,000 loan into $2,400 in total payments. And that's assuming nothing goes wrong. No missed payments, no late fees, no over-limit charges. The moment this customer stumbles even once, the bank tacks on a $35 late fee. Sometimes they bump the interest rate even higher as a penalty. It's like if Netflix charged you $8 monthly when you watched responsibly, but $47 if you binged while behind on other bills. Now check this out. Banks aren't stupid about defaults. They know some people with bad credit won't pay at all. Some will default, declare bankruptcy, or just disappear entirely. That's called the charge-off rate, and banks factor it into their models. But they charge so much more in interest and fees to bad credit customers that even after accounting for defaults, they still make significantly more profit overall. Think of it like a casino, where some people win big, but the house edge is built in. And across thousands of customers, the math works heavily in the casino's favor. Banks do the exact same thing with credit cards and loans. They'll lose money on some bad credit customers who default completely, but they'll make double or triple on the ones who stay trapped in minimum payments for years. This is where the system reveals its true design. Banks use sophisticated algorithms to identify the sweet spot. Customers risky enough to need credit desperately, but stable enough to make at least minimum payments. These customers stay in debt for years, sometimes decades, paying interest that compounds monthly. A $2,000 credit card balance at 25% APR with minimum payments becomes a 15-year commitment. Over that time, the customer pays roughly $5,000 total, $3,000 in interest alone. The bank didn't create anything or provide ongoing services. They just let the debt sit there while interest accumulated like snow piling up on your driveway during a storm. This matters to you because the entire system extracts maximum profit from financial vulnerability. Someone with bad credit is often in that position because they've had financial struggles, medical bills, job loss, divorce, or no education. They're the ones who can least afford 28% interest and $35 late fees, but they're the ones getting charged the most. It's like charging extra for an umbrella only when it's raining. The pricing structure punishes people who are already struggling, and it's not an accident. It's the business model designed to maximize profits from those least able to afford it. Risk-based pricing sounds fair on the surface. You're riskier, so you pay more. But in practice, it means banks make their highest profits from people least equipped to handle the cost. And it gets worse with other banking products. Overdraft fees are a perfect example. If you've got $800 in your account and accidentally spend $805, the bank could just decline the transaction. Instead, many banks will approve it and charge you a $35 overdraft fee. If you make another small purchase, they'll hit you again. Some people get charged 3 or 4 overdraft fees in a single day, racking up $140 in fees on $20 of actual overspending. And who gets hit with these fees the most? People living paycheck to paycheck. Customers with big balances almost never pay overdraft fees. The bank's profit center is the person who's got $12 in their account the day before payday and forgets about the Netflix charge. Payday loans and subprime auto loans follow the same playbook. Payday lenders charge effective interest rates of 400% or more annually. They specifically target people who need $300 to cover rent before their next paycheck. Subprime auto loans come with interest rates of 18 to 25%, plus mandatory GPS trackers and kill switches. The worse your financial situation, the more expensive it becomes to exist. You pay more to borrow money, more in fees for basic banking services, more for car insurance because your credit score is low, even though your credit score has nothing to do with how safely you drive. Everything costs more when you're broke, which makes it exponentially harder to stop being broke. Here's what you need to understand about this whole system. Banks could offer lower rates and fewer fees to struggling customers and still make reasonable profit. Credit unions and some smaller community banks actually do this. They charge lower fees, offer financial counseling, and focus on long-term customer relationships instead of short-term profit extraction. But the big banks and credit card companies have shareholders and quarterly earnings targets. There's way more money in charging 28% interest and $35 late fees than in helping people build financial stability. The system isn't broken. It's working exactly as designed, just not for you. It's optimized for profit extraction, and the business model depends on customers who carry balances, pay minimums, and stay in debt for years. Responsible customers who pay off their balances? They're not the target market. They're just the people in the commercials. Some people are fighting back by learning how the game works. They use credit cards strategically, paying off balances in full every month to avoid interest while collecting rewards. They build emergency funds so they don't need payday loans or overdraft protection. They check their credit reports, dispute errors, and slowly rebuild their scores until they qualify for better rates. Others push for policy changes, capping interest rates on credit cards, banning overdraft fees, or requiring banks to offer low-cost basic banking services. Some states have already banned payday lending entirely, and a few banks have eliminated overdraft fees after public pressure. The credit card industry also profits from another layer most people don't see. When you swipe your card, the merchant pays a fee, usually 2 to 3% of the purchase. For premium rewards cards marketed to people with excellent credit, those fees are higher, sometimes 3.5%. The bank uses that extra money to fund cashback rewards and travel points. But banks would rather have one customer paying 28% interest on a $5,000 balance than 10 customers with perfect credit earning 2% cash back. One struggling customer can generate $1,400 annually in interest alone. 10 perfect credit customers might generate $200 combined from merchant fees after rewards costs. The struggling customer is worth 7 times more in pure profit. To recap, banks make significantly more profit from customers with bad credit through higher interest rates, fees, and longer repayment terms. Responsible borrowers, who pay balances in full, are called deadbeats internally because they generate almost no profit. Risk-based pricing sounds fair, but actually extracts maximum profit from people who are already financially vulnerable. This system makes everything more expensive for people who can least afford it, trapping them in cycles of debt that can last decades. So knowing all this, here's the real question. Should banks be allowed to charge whatever rates they want and call it risk-based pricing? Or does profit extraction from struggling people cross a line into predatory behavior that needs regulation and reform?